look at the 2011 high on that chart there, it got up over 3%. Divide an ounce of silver into an ounce of gold, it was 3% plus. Right now we're above one. It's still cheap versus gold. And it is a monetary metal.
Hmm.
Don't let thousands of years of history go by. It's a
Yeah.
monetary metal. And there were same things going on with the miners, the XAU index versus gold down below, and the Huey versus gold. They both broke out of relative performance situations too. So they're saying, hey, buy silver and buy the miners. Yes, gold is the mama, but we're going to outperform the mama market
Yep.
within the
Yeah.
complex. Now look at the gold chart below. Go to the next page. Just simple, stupid price chart. Okay. Well, we're higher than that right now. In fact, if you uh, factor in that we're rotating to June gold, then we're well above that last reading. But there's 3 months up there, effectively stalled at the same price level. You get up to 53, 5,400. There was one spike above 55, but basically, at 3 months pounding the same level. Gold doesn't peak that way. If you go back to 2011, when you made your high in September, I think it was 2011, you dropped from 1900 down into like the 1500s. You never
Hmm.
came back anywhere close to the 1920 price high. You
Hmm.
came up into the 1700s again, but you couldn't get back up to the old high. Well, if
Hmm.
you internally look at gold on a daily chart, anybody who's watching this right now, go to your quote screen, punch up a daily continuation of gold, you'll see that the peak daily close back in late January was just above 5,300.
Hmm.
Early this month, we had a peak daily close just above 5,300. In other words, not only does monthly price chart go back up into that supposed thin air, but the daily price close went back up and effectively matched the peak close of January. In other words, the air is not as thin as you think up here. You shouldn't have been able to go back to the high again. We're saying now you go back to 5,300 gold again, they're going to blow your head off.
Yeah.
And for silver, we think the key level is getting back over 90 again. And we're talking price now, not
Yeah.
momentum. Momentum will give you earlier signals, and those are in our reports. But for just a price chart guy, if you want to know when this quote correction is over with, which has really been a violent sideways consolidation, if you look at it, you get back over 90 on silver and you get gold to 5,300. You better cover your shorts or you're going to wet them because they're going to blow at that point. And
Yeah.
you're going to get the acceleration that we expected in this couple quarter surge. And consider what you saw in late January to be the midpoint correction, uh,
Got it.
time wise. I think silver could be $300 to $500.
That's
You
a
get back,
beautiful thing.
serious, yes, no. And the factors in play are both the monetary aspect, because if during that same time we see those S&P charts, one, have a little bounce now, waste some of late March, early April, maybe a
Hmm.
couple weeks here, have a nice rally because the Iran thing abates or whatever. And then you roll back through those annual and quarterly structures we showed.
Hmm.
You're going to have a blood flow. And already some smart money's been moving into what? Not T-bonds,
Yep.
gold and silver.
Gold
Yeah.
and silver.
Okay. You'll have a massive money flow out of that broken bubble into
Yeah.
gold and silver once it becomes a public awareness that, oh my gosh, it's really broken.
Yep.
And the central bank will go berserk. And we
You,
already know, the new Fed chair is going to go berserk.
yeah.
Yeah. Okay.
No, I like that you marry everything too. Not only the technical, which is what you're known for, but also just the fundamental here. And I do have that same expectation as the stock market tops out. They
Mhm.
got to keep this thing going. They just got to keep it going. That money flow's got to go somewhere. And how are they gonna, how are
Well,
they gonna
yeah.
prime prime it?
Watch, by the way, one thing we pointed out back in October, and since then we've updated and updated. Everybody's looking at AI. Yes, AI ultimately will lead the downside.
Hmm.
The leader in the prior bull usually will lead the downside, mean suffer more.
Right.
But it's only been AI was only the leader in the last 3 years of that bull market, not since 2009, but only in the last couple of years has AI really been the leader. What you got to watch is financials. And we've been watching them and they've been bleeding badly. Not in a collapse. No, no, no. But badly technically, where those structures that we showed on S&P, like the quarterly momentum, they've already
Hmm.
blown those structures.
Hmm.
Some key banks have blown those structures.
And think about that.
Yeah,
That's
that is what upsets the Fed more than anything.
yeah.
So are they going to go berserk? You bet to you they are.
Yeah.
Uh,
Yeah. Think about that. No, that's great insight. Yeah, no, I mean, I think you really nailed it here too. Talk to me about page 6 here on your report here. And you
Well,
might,
there's just these are shorter term, and it's there's levels that we're toying with right now, and this is last week, so they're not up to date. Uh, you don't have to hold on those charts, by the way. The There are near-term momentum factors, things like weekly momentum, not the monthly things that we were looking at before, and annual momentum and so forth, but where you measure silver and gold versus very short-term metrics to try to
Mhm,
define when a short-term sell-off is turning back up. So, for example, silver early this month was what, $90 early in the
mhm,
month again. It closed the day up there. And then you started down. Well, when it came down into below 80 again, we said there could be a break. Sure enough, there was. And the break ended up taking out the February low. Well, the miners are vastly, vastly undervalued historically to gold. In other
right.
words, if you take the XAU index, which has been around since the 1980s, like GDX hasn't, it was only around since 2006. So take something that's been around a while. An XAU index, if you divided the price of XAU, which is the Philadelphia Gold and Silver Miners Index, by the way,
Mhm,
and divided into 1 ounce of gold, you'd see that from 1980s, 90s, up through 2008, so for several decades, its average valuation divided into gold was 25%, which was always worth 25% of 1 ounce of gold, one share of
mhm,
XAU. Sometimes it was 35%, and it had lows like in the 17, 18%, but on average during that multi-decade period, 25%, let's call it average valuation. You know where it collapsed to in 2015?
Tell me.
4%. What do you think? It's going to be free? Okay.
Mhm, right?
They're the people that get it out of the ground. And they were worth 25% on average. And now, then 2015, 4%? Give me a
Mhm,
break. Okay. Right now, they're worth like 7.5 to 8%. Okay. By our metrics, XAU versus gold spread chart and Huey versus gold have both emerged enough in recent months to break out of the basing pattern that they had since 2015, indicating, hey, we're alive. We want to go to a normal valuation to that which we dig it out of the ground. Okay. Well, heck, even the bottom end of that multi-decade range of relative value of XAU to gold was 17.5, 18%. Well, right now, that's more than a double in their relative value just to get to the bottom
right.
of the prior multi-decade valuation zone,
Yeah.
doubling in value. Meaning, if over the next 6 months or a year we see gold go up to, some minimum high like 8,000, which by the way, JP Morgan has now come up and said 9,000 2 months ago as an
Mhm,
ultimate. We think 8,000 is ridiculously cheap still because that just matches the two prior bull markets that occurred in the last 50 years. There were eightfold moves. Ours is right now at, let's call it, we started from 1,050. You do the math. 8,000 would match those moves. Okay. Merely match them. But if you took gold to 8,000 and doubled the value of the XAU index from where it is now, it'd be like a tripling in the price of XAU.
mhm.
So
Think
we
about
think
that.
we think the potential for silver to gain versus gold, which is still very cheap versus gold historically, and miners versus gold is enormous.
Mhm,
So yes, watch the mama market, gold, but the children are about to surge in front, okay, or the puppies, whatever you want to call them. They're about to regain value
yep.
and go back to some normality, not even excess, in valuation, which would take their price off the page.
Our position isn't what most people's position is, right? So about a month or so ago, we moved out of the equities market. So we flat. When the market gets like this, when it is like the stock market, for example, is trendless, like really it traded sideways in a range. The S&P 500 and the Nasdaq, pretty much from the October highs. It's been like 6 months of just noisy chop. And when the market does that, you want to step aside, and so that's what we did quite a while ago. I mean, we actually exited our gold and silver when positions when their silver was up at 113, gold was well over 5,000. And when the market was giving all of these signals, that's when we took action. And so all of this noise that's going on right now, we are completely sidestepping it. We're watching it from the side. We're just collecting daily interest safely as a position because we don't want to get involved with our portfolio in this type of noise. Now, there is opportunity, obviously, if you're an aggressive active trader, but as an investor, somebody looking to protect their capital, who just wants consistency. They don't want to wake up every morning, hoping and praying the market didn't move against them. Because this market right now is very dangerous. We got the S&P 500 breaking down from what looks to be a topping pattern. The NASDAQ is doing the same. We've got the dollar index trading at the 100 level on the verge of breaking out and rallying. If the dollar breaks out, that probably means